Hey, everybody. This is Corey Mortensen, your host for the Mastering Commercial Real Estate podcast. I have got a great guest lined up today. This is Tanner Noble. I'll let him introduce himself, but he is a commercial real estate company owner, syndicator. I'll let Tanner do his own introduction. And Tanner, why don't you go ahead and tell us a little bit about yourself, your company, and what you do?
Yeah, man. First of all, thank you for having me on. I'm excited to be here, and it's really cool to see what you're doing, what you're building, and yeah, excited to be a part of it. So thanks for having me.
Yeah, thanks.
So yeah, I'm Tanner Noble. I'm a principal at Rebus Capital. We are asset managers and syndicators of multifamily real estate. We've got right now we have about 800 units, and we've got about 600 of those are in Houston area, 90 units in Austin, 145 units here in Lubbock. I'm based here in Lubbock, Texas, and yeah, I got into the business in about 2016. Started with the syndication of a 16 unit townhome property and just kind of started growing from there, and here we are today.
Yeah. So tell us a little bit about what, your background, your past before commercial real estate. Where are you from? Where did you grow up? And what were you doing before your real estate career?
Yeah, so I'm from Lubbock, Texas, born and raised. I went to Abilene Christian for college and got a finance degree. So, other than those 4 years of college, I have lived in Lubbock, came back after college, married my high school sweetheart. We've been married for 18 years now. Got four daughters, the oldest of whom is 6. After college, I did just some accounting and finance jobs. I worked for my dad. He's a part owner of a title company here in Lubbock, Service Title, and I worked for him for 2 years. Did some funding for just closings, just, primarily single family closings, and then from there, I decided I wanted to do something different, not in the business world, and so I set off and did a bunch of different things. I tried to get in the fire department. I went back to school, got prereqs to go to med school. Um, my wife and I both quit our jobs and became house parents at the Texas Boys Ranch for a year. Had 25 kids come through our cottage in a year's time, and that was the hardest job I've ever had.
Really?
But then, so right before that, I was working for United Supermarkets, which is a grocery store chain
Oh,
based in
yeah.
Lubbock. I was working at their corporate office as a financial analyst, and it was my job to build out the P&Ls for quarterly P&Ls, and so learned a lot there about profit and loss statements and how, like, kind of the high level business overview stuff. So anyway, after the boys ranch, I was looking for what was I going to do next, and so I ended up getting my real estate license. Started selling houses, and we've had a mastermind group, me and some buddies, since 2012 is when we started it, and um, we met weekly, set goals, held each other accountable. Well, when I got my real estate license, me and another one of the guys in that group decided we were going to try to flip a house. So we bought a flip house, we flipped it successfully, bought a duplex. And also, me and him were in the process of trying to start a valet trash company here in Lubbock. And so we went around for like 6 to 9 months, going to apartment communities trying to sell this, and nobody wanted it. Like, nobody wanted it. And so we didn't end up doing that, but we did meet with a broker to get contacts for owners, so we could figure out how do we sell this to owners. And in that conversation with that broker, I just kind of jokingly said, one day we might want to buy an apartment, so keep us in mind. And he was like, well, we have a 16 unit off market right now, would you want to look at it? And we were like, yeah, sure, what does that mean? And And so he showed it to us, and we took it back to our mastermind group and said, "Hey, we're thinking about like maybe trying to buy this. Does anyone want to join?" And we had another buddy that decided he wanted to, and he said, I've got a client that he had been training in CrossFit for like 6 years. He was like, I think he's got some money. He has a private jet, so I think he's got some money. So I'll see if we can get some money. So anyway, we spent the next 6 months trying to figure out how to buy a 16-unit apartment.
Yeah, well, that was going to be my next question was tell us about that first deal, and that was a perfect segue into it. So, what was the biggest challenge with getting this first deal put together? What was the structure? Kind of tell us more details about that first deal and what you did to take it down. Tell us how it came into your lap, but tell us a little bit more about how you took it down and the business plan and how it went.
Yeah, so I would say right now the hardest problem is finding deals. And so with that first deal, that was it's kind of ironic that one, just like you just said, fell in our laps kind of.
And when was that? I don't mean to interrupt. When was
That
that?
was in 2016.
2016. Okay.
Yeah, so we thought that the hardest part was going to be raising money from investors, and it turns out that was not as hard as we thought. The hardest part was getting a loan from a bank. When you go and you buy, so that property at the time was $800,000, and we were all three, young in our careers. We didn't have we just gotten out of debt. We had basically a net zero balance sheet. And so with that, and then with no experience in managing an apartment or, owning real estate, really, the bank really is like not super willing to take a risk on that. And so what we ended up doing was getting our first investor to guarantee the loan. And so what we did was we went to a local bank here. We got them to, first, so let me back up a little bit. In talking with our investor, he had a person on his team who was familiar with real estate. And so they just asked us a ton of questions that we didn't actually know the answers to. And that was our first really, really good lesson in how to actually do this, because they asked these really good questions and we had to go figure out what were the answers to them. And so in doing that, we learned a ton. And I'm talking about questions like, what's the return going to be? Or, how much money are you going to invest in, remodeling the units? Things like super simple things in hindsight. But at the time, we just didn't know. We didn't know what we didn't know. And so finding out answers to all those questions really helped us build out a business plan. So we built out this business plan that now we could go and we presented that to the bank, and got the investor on board with guaranteeing the loan. And that's how we kind of packaged the deal. And, traditionally in most of the groups like us, the way the deal's structured is it's like an 80-20 split with some preferred return, like a preferred return. And then there's a carried interest after that pref is met. So usually it's 80-20 with, like, back then it was an 8% pref was pretty typical. And then, we make money also by charging an acquisition fee. Kind of just helps cover the cost of doing business, really. And that's usually 1% of the sales price. Well, what the investor challenged us with was, he was like, I don't really want to just pay you this acquisition fee and then you guys just run off and decide, hey, we made this check and we're done.
Right.
And so what he made us do was put that into the deal as equity. And so that really, it hurt when we first, because in our minds we were like, oh man, we're going to buy this. We're going to get a check up front.
Yeah. Because how big of a deal was that at that time?
It was $800,000. So, and I think our acquisition fee was, I want to say it was $40,000. I can't remember actually now. I think it was 40,000 though.
Yeah, yeah, decent chunk of change.
So yeah, it was great. And so, but we didn't we rolled that in as equity. And that turned out to be great because when we flipped that deal in like a year and a half basically. And so that equity had grown also. And so we actually made more money on the back end that way. But that's how we structured our first deal.
So when you were handling those objections, and it was just one investor that came in with you on this deal, right?
Yes.
Yeah.
Well, actually, no, I take that back. It was him, but he also had employees that invested too. So we had about, I don't know, 5 or 6 investors.
Okay, but he kind of
He
brokered
took the
everything.
big check.
Yeah, okay. When you were getting those questions and you didn't know the answers to them yet, it was your first go on this deal. What were you saying? Were you just like, I'll get back to you? I don't know. Or did you
Yeah.
kind of say something where you're like, sounded good enough for the time and then you got a more serious answer? I'm curious.
No, yeah, it was more of, yeah, I don't know the answer to that, but we can find out.
Mm-hmm.
And so when we had our first meeting um with him, and he had another guy, it was his controller at his company that had all these questions. And so basically we just said, why don't you get us a list of questions? And so they emailed us a list of questions after that meeting. And that's how we just, so then we go through this list. I mean, it was a long 2-page list of questions. And so
Mm-hmm.
we just kind of divided and conquered. That's where having partners is like that it's super beneficial, because when you get to these hurdles in anything, but in starting a business especially, you get to a hurdle or an objection or this wall, and it's like you have all this self-doubt, like, man, I don't know if I can do this, maybe I should just quit. And then you have a partner like, no, we can do this, let's go find the answer to this question, and you're like, oh, okay, yeah. And so you just like work together, and that part has been really, really beneficial for our company.
So that was the first deal. How is your process changed from when you were first getting started on that deal and your second deal, third deal? What are you doing now that is so much different from what you were doing way back then when you were first getting started on your first few deals?
It's a good question. One thing that's changed, it's funny, my partner Steven and I were talking about this yesterday. We were looking back. Yesterday we went and we toured a 3-pack here in Lubbock that's 860 to 65 units or something.
Wow.
So 3 properties. We went and toured those, and we had actually toured the same package in 2017 when it was for sale. And so we went back and looked at our analysis, our underwriting, and that in the beginning it was a pretty simple spreadsheet, and now it's after 7 years of building out a spreadsheet, I mean, it's a pretty robust financial model. So that's one thing. We're way more granular in the level of detail that we put into our underwriting. Another thing that's changed, back then when we started, we were kind of looking at 70s vintage property. We were looking at more Class C stuff. And today we're not looking at 70s, for sure. We look at 80s and newer, but we prefer to look at, newer assets. We
And why
really
is
are
that?
focused. Really, right now, well, not right now, but always. It's, as an asset just gets older, there's just so much more to deal with. I mean, plumbing is probably the number one answer for that, is because in 1970s, you get a lot of cast iron plumbing, and most deals in the 70s now are just their plumbing is just shot, or it's leaking, it needs to be replaced. So that's just a huge capital expense that we don't want to take on, because it doesn't give a directly correlated increase in income to fix that. So it's hard to justify that. And for a lot of people, that's their business plan and it works for them. It's just not ours.
Mm-hmm.
And then Yeah, just obsolescence in general. So plumbing is the first one that comes to mind, but there's other obsolescence things that, I mean, aluminum wiring, for instance, in
Mhm.
electrical. The two of the deals we toured yesterday had stab lock uh, breaker boxes, which if you get a government-backed loan, Fannie or Freddie loan, they're going to make you change those out. That's a really big expense. So that's why we're looking at newer than 1980. Um, and then
And it's
also the second thing is location.
gotcha.
We're way more particular on location now than we were back then. I mean, we want to be in really good locations that are going to last, forever.
Yeah, and I'm obviously, I look at a lot of deals in Lubbock as well. And it's funny, people talking about the potential, and Lubbock has grown so much. Lubbock is a market, and in just the last 5 years, even 5-10 years, it's been dramatic changes. But that is the most important thing, because Lubbock, if you're not familiar with that city, you could easily be looking at a deal that's in a neighborhood that's not going to go anywhere. I see a lot of deals coming up on, the very far east side, far north of Lubbock. And, you can find good deals, good pockets in there, but you got to know what you're getting yourself into. And it just goes to the age old adage of location, 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 and investing on that. In terms of
Yep.
your return structures, how that's changed, what are you generally looking for on a return as you're looking for deals? Because I know you mentioned it earlier that finding a deal right now is the hardest thing to do, and I'm going through that. Everybody's going through that. We're just coming off the top of the market now. I mean, we're recording this May 18th, 2023, and interest rates have changed everything so much. So how is your return structure and what you look for changed over just the last year or two?
Yeah, that's a great question. Um, Hard to answer. I mean, we haven't really changed. We just don't find any deals.
Is it because
Our
that's I
return
mean that's a
structure
big
you say it in the last couple of years. From the very beginning, we've changed a couple of things. We've gone through time, like we've done deals where we've done like a bigger split, like a bigger carried interest, and that's just not been great to do it that way, because when you look at the exit, then you have to make a lot more money. The value of the property has to go way more high. So 80/20 is kind of our standard split now. And then on the pref side, or the pref equity part, or not pref equity, but the preferred return, I'm sorry, preferred return. Like I said earlier, we started out at about 8%. I think we might have done a 9% on one deal, but now, I mean, it's closer to 6%.
yeah,
And that's
that's a
just
really high pref.
because cash flows are, not near what they were in the teens, the 2010 decade. In that decade, you could find deals you could buy an 8 cap and you could cash flow it day one. You could just cash flow 5% or more, and average 10% over the life of the hold. And that just doesn't hardly exist today.
And
And
why do you
so
think that
that's changed.
is?
I mean, cap rates have come way down. Uh, the values of properties have gone way up, and I think that that's you know, partly because of interest rates. We went through, we just came out of a really, really low interest rate environment. So I think that helped drive the values up. I think that in Texas, the demand for, you know, migration of people into the state has just gone through the roof. And so housing has just, the demand for housing has just gone through the roof. And then also, I think that a lot of the traditional value add was you go in, you remodel the interiors, and because of that, you can charge a premium on rent because now your interiors are nicer and tenants want a nicer unit and all that. And so that's been done over and over and over again over the last, 15, 20 years. And so that value has just kept inflating these assets. And so I think those three things have helped.
Yeah. Do you think it's
Get
a lot
values
of
up.
the, like you said, just people have been doing this. People have been doing the value add, and it's really gained a lot of popularity. And would you agree on this in the last 5 years for people to go and do this as it's gotten, let's call it mainstream?
Absolutely. Yeah. And you got, gurus that help teach how to do it. And they attract a bunch of people. You got like your Brad Sumrock, you got Grant Cardone and Lifestyles and these other groups that, I mean, they've just brought in a bunch of different um, owners to the market. And yeah, the demand to own apartments has also gone way up. Like you said, yeah.
Yeah, exactly. It's become a really saturated space and making it so much more competitive. And even for, I mean, I think with the prices going up, and it's like, okay, we see these deals on the market, off the market, what sellers want, and the ones that are going on market, we take a look at, and the price is way too high, but somebody ends up buying them. And it's either, kind of one of two groups. It's the, in-house all equity group that doesn't need as high a return as we would need in order to syndicate. And so we're already at a disadvantage, or it's a novice investor who is looking to take this in, just doesn't know the value and thinks that they can push rents 100, $200 just because they put a new sticker on it. And just because they raise the rent, but they're not going to get it. And so in terms of opportunity, where do you think the opportunity is going to come from in the next year or two? I mean, I'm hearing, people say that the interest rates are going to come down a little bit, but they're already kind of at historical norms. What is next for the commercial real estate investor in terms of opportunity?
That's a great question. That's, of course, the billion-dollar question
Yeah,
that
this is
everyone
your
is
crystal
asking.
ball question.
So, in my opinion, there's a lot of talk right now about people that got bridge loans in the last 3 to 5 years, and they're coming due, and they're going to have to either refinance or sell the property because they got this floating rate bridge loan, call it 3 years ago, and now they're about to have to refi, and their debt service payment is going to double, you know, and their insurance cost has probably gone through the roof. I mean, we're looking at deals especially close to the water in Houston, that are right now, your pro forma's got $2,000 a unit in insurance. Whereas the deal I just talked about that we looked at yesterday, in 2017, we budgeted $200 a unit for insurance on that deal in 2017. And then today, it's probably more like 800. Even in Lubbock, it's 800 a unit. And so, yeah, insurance rates. Sorry, I lost my train of thought there. Got to get on a soapbox on insurance because it's crazy right now.
I
And
know.
taxes too, property
I know my
taxes.
buddy, he was getting a deal done in South Texas, and it was a 72 unit, and they were getting insurance quotes on it, and they had originally gotten a quote for, I mean, I think it was like 1,000 a unit, 900 a unit, and they were calling around. They got, I think, 5 or 6 different quotes, if I remember correctly, and they were all crazy high. But then they went to that servicer, the one that was already servicing the property, and they gave them a quote for half. So they got a really good deal. I think it was like 36,000. I probably have the number all wrong, but really affordable rate. And but that's one of the biggest challenges is on our underwriting is, yeah, we've got a budget for higher insurance, higher property taxes. I mean, every single person that's thrown a pro forma or a T12 my way thinks that the taxes are going to stay exactly the same. The insurance is going to stay exactly the same. Management and expenses are all going to stay exactly the same. And it's a trouble in terms of your management with seller owner broker expectations and saying, this is what we are going to get. This is not how the property is going to function. How do you speak to brokers, owners in managing that? Hey, here's what it's really going to look like versus what you guys have been or are showing. You know what I mean?
Yeah, and I mean, going back to your original question of how do you what do I see in the opportunity is the reason I was saying all that is because those people that got those bridge loans are allegedly going to be seeing all of those things going up, just like we are in when we're in our underwriting. Like they're going to be seeing that too, and they're going to realize like we can't afford to pay all of these expenses and the new debt service payment, so we're going to have to sell. And so I think there is going to be a conversation soon with those sellers of this price doesn't work. You're going to have to take a bath. Your equity is going to have to take a bath. I mean, we're already seeing it happen for sure. Like, we saw a 4-property portfolio in Houston that got foreclosed on a couple weeks ago. And so those equity investors, to my understanding, is they just walked away with nothing. They lost all their money. And so, I think we're going to see more and more of those conversations. And I think that there's got to be some kind of, I keep hearing the words rescue capital in kind of the circles I follow.
I haven't
There's a
heard
lot
that term yet.
there's a lot of people that think that when those deals start going south, that there's going to be a rescue capital option that, whether it be a fund that says, hey, we're going to come in, we're going to do a cash in refi for this much equity or something like that. Maybe that's an option. Other people think that the government will step in and help somehow. I'm not sure how. So I don't know. I think that there will be opportunity in my mind right now. I'm not saying 2025. I think we'll start seeing a lot more opportunity. But you got to think, I mean, everybody's been saying this is going to happen. This is going to happen. This is going to happen. But you got to think once it does happen, there's so much money sitting on the sidelines that everybody's going to go bid for the same property, and it's still going to keep the price high.
Mm-hmm.
And so I really don't know what's going to happen. I'm anxious for this period to get behind us so we can be on the ground floor of another rise,
I know, me too. And if that doesn't happen, if everything kind of stays the same and we've entered a new normal, do you think the next step is investor expectations? Because in the landscape of raising money, you can raise a deal pretty quick at 20% returns, doubling your money, tripling your money, on a 5-year timeline or even quicker. And investors have gotten really used to a 3-year turnaround and doubling or tripling their money or even more on some of these value add deals. But obviously that time is gone. Is it changing expectations for the investors and saying, hey, these commercial syndications, these private equity investments aren't going to net you 20, 15%. We're probably going to be around 10%, 7%. But you get all the benefits of, owning a passive real estate investment versus stocks or something like that. Do you think that's another conversation in the future, or how do you think that's likely?
I think you're absolutely right. I think it's definitely going to take a shift in expectation. And I think that, looking to our past to see how was that navigated in 2008 is something that I'm really interested in learning right now. Like this has happened multiple times in our history, and there's a lot of people alive that lived through those events. So how did they navigate that, in 2010?
Yeah, I think that would be a really good insight to start studying on and just saying, okay, what's a period of time that mirrors, a downturn in commercial real estate, and how did it affect the operators? What did investors do? And just kind of getting into the minds of people and how they got out of that.
Yep. Yeah. And in a market that is more like, someone that was in Dallas in 2010 investing in Dallas is going to have a completely different answer than someone that was in LA, where cap rates in LA were, probably in their sub 4 versus in Dallas in 2010 they were in, 6 to 9. So I think, yeah, but you have a great point. I think that investor expectations need to change. And you also mentioned having other advantages other than just doubling your money. I mean, there's tax advantages, there's your own hard asset, and I think that especially if you can set your expectations for a longer term, like you mentioned too, I mean, if you look at history, history repeats itself, obviously, and it's going to come back. It's going to come back in a big way. And if you can buy assets today that you can hold long term through that, then I think you'll be in a good spot.
Right. And that's why we like multifamily so much, because it is a downturn resistant asset. And that's why we like it. That's why investors like it. And so, yeah, I think that, yeah, we'll probably just have to manage expectations and see what happens. But we talked a little bit about expenses and what's going on that side. As far as your forecasting for incomes, rent growth, other income, what are you looking at on your underwritings? Because on ours, we've gone even for, I mean, we were conservative to start, but now we've taken off our 2 to 3% rent growth almost down to 0 or even negative for a year or two. Just given everything that's happening in the landscape, we've seen rents come down, at least here in Austin. I know in a lot of other places, they've either stagnated or come down. What are you doing? What are you seeing on your forecasting for incomes?
Yeah, so same thing. I mean, in fact, I was looking at some CoStar data yesterday, and they're projecting out, negative rent growth in DFW for the next several quarters. And so, yeah, I think we're the same. We're probably more flat for first 2 years and then picking it up a little bit. We haven't had any deals, I'm trying to think, that we've been super close on lately. So we really haven't had that internal discussion of setting that recently, just because we haven't had anything close, even at 3% increases,
Right.
So.
And I guess a better question to ask is, on your current portfolio, are you having any trouble with rent increases? Have you done any rent decreases?
No, we haven't had any decreases in our portfolio. We do actually in Austin, our deal in Austin, we still are having pretty good rent bumps at renewal. So I don't think we've seen any decrease in our portfolio yet.
Why do you think that is? Is it because of the quality of the properties, good investments, good quality of the renovations, business plan, or do you think it's more the market and in combination with what you guys have done?
That's a great question, and I don't know the answer to that.
That one's tough to tell.
It is. I just don't know yet. I mean, because it's so new that some markets have decreased, that it's too soon to tell, I think, for us.
Right. And I got a Dropbox memory the other day, and it was an OM that we were taking a look at. And I was like, I wonder what that OM was looking like versus how it would look like today. So I peeked at it, and they had rent as a broker OM, and they had projected rent increases 10% for the next, I think, three or 4 years. They were so optimistic and confident that, yeah, they were going to get 10% after getting back up to market and renovations and everything. So they were like, yeah, we're getting 10%. Everything's going up. It'll never stop. And I remember looking at that one and being like, these guys are crazy.
Well, and I'm sure that whoever bought that deal had a similar underwriting in their own internal underwriting, and that's how they won the deal, because they they bet on that rent growth.
Exactly.
So that deal, you keep an eye on that deal, because it may be coming back to you soon.
I know. Well,
at a
I've
way
started.
price, a discounted price.
Exactly. I know. Well, I've started developing a tracker for every property that we've looked at, and when we looked at it, everything that we assumed on it, what they were looking towards, on the seller, the OM, or anything in terms of their assumptions, and so that we can come back to it. Kind of similar to what you were mentioning earlier with that. I think it was that 3 property portfolio that you had looked at in 2017, right? 2017 or
Yeah.
quite a few years ago, and then came back. That way we can say, okay, what happened to the business plan? What were they projecting? What actually happened? How did it look? Just because that knowledge is going to be really, really key.
Yeah, that's smart, man. That's a great thing to do.
Yeah, I think just have it because there's no history for commercial real estate. On the MLS, you can see, okay, what did it list for? What did it sell for? What, that's a pretty easy thing to find and figure out. But in terms of commercial real estate, so much information is proprietary in terms of
Yes.
what each company, each person, and really the only big group you can find any information is CoStar. Crexy's coming up. I really like Crexy. I've had a few people say that their intelligence platform is pretty good. PropStream as well. Do you use any of those tools? I know you use CoStar.
Just CoStar right
Tried and
now.
true.
I haven't even looked at Crexy since it first came out, so maybe I should check it out.
Yeah, even in just the last year, it's grown quite a bit, and I know they've invested heavily in becoming an affordable and an accessible CoStar for the average investor, trying to make it more accessible, and I think they're doing a pretty good job. But moving right along in terms of the challenges that you have faced as an investor, what is some of the times that you got really close to, let's call it failing, something was, really blowing up on you? What was a big challenge that you didn't think you were going to make it out of, if you had one, and how did you get out of that?
Put me on the spot here.
I'm willing to take a bet that it was a raise.
Yeah, I don't know if it was a raise.
And tell me
I don't know, man.
if everything's been cherry, you
No,
can say that as well.
it is not. It is not. There's been plenty of problems. I'm just trying to think of a good one, a good story to tell that would be interesting.
Any times the renovations blew up, or you had a way higher
Yeah,
expense?
that's a good one. So we actually just had this happen in the fall. One of our Houston properties, we lost an entire building, 24 units, I believe, to a fire.
Mm.
And so we are still dealing with that today. And the property, we bought that deal at a very good basis, and it has been just kind of humming along. It's a 2000 vintage, and it's been doing really well. And then we get this, and now it's like, it's been the bane of our existence since it happened. And so some of the challenges that come through that with that are, luckily we had business income loss insurance. And so, luckily we're able to, that means that the income that you would have received from those properties, the insurance now pays for that. So it's like as if you still get the rent check. But to get that check from the insurance has been an incredible challenge, and they only do it every 3 months. And then also dealing with the city of Houston on that project, we have some units that are ready, that are renovated and ready, but they won't give a CO until the building is ready. And so, now we've got these units that are ready to lease, but we can't lease them until all of the units are ready. And so that's put a damper on it. I think that I have very little to do with the success of that project, but my partner Albert has a lot to do with it. And it's because he is, as an asset manager, you can go two different ways. You can be very laissez-faire, hands off, just like, I'm going to so we hire third-party management. So I'm just going to let the management company deal with everything and trust that they're doing a good job. That's one way to do it. That is not the way that we do it. And so Albert is very, very hands-on with the property management companies, and it's allowed him to, stay on top of things like collecting those checks. And if it weren't for that, we maybe, down the road a year from now and never have seen any of that money from insurance. So, yeah, I think in that story, perseverance has been sort of the perseverance and persistence. Persistence is really actually the word I wanted to use there. He's very persistent at staying on top of things, making sure we don't drop the ball. And yeah, I think that's brought us a long way in many, many different parts of our business.
Yeah, and that's a perfect segue into what was going to be my next question was, what does your team look like right now? How many people do you have working with you? You mentioned your partner Albert. What does that look like on your end?
Yeah, so it's me, Albert, Steven, and Brandon are partners in the business. We have a executive assistant and an analyst, and that's all we have in our office in the corporate. Everything else we have outsourced. We've outsourced a fractional CFO, and they do all of our bookkeeping and accounting. And then we have we hire third party property management to run the properties. So yeah, and then with my partners, so I'm more of the deal flow, meeting with brokers, getting the deals in. Steven does the underwriting along with our analyst and acquisitions. He deals with the acquisition process. Albert does the more of the operations, like I mentioned. Like once we buy an asset, he's really involved with helping carry out the business plan. And then Brandon, our fourth partner, is really involved with raising equity. We all do, a version of all of those roles, but those are kind of where we focus.
Right. And what would you say? Because you mentioned that you're kind of on the deal flow, getting that pipeline built out. Would you say that that's your key strength? Is there any other strengths that you take over in terms of what you like to handle in your team?
That's primarily what I do best is going and meeting, finding the new opportunity, like whether it be a deal or a key relationship or a solution for new technology or whatever. That's kind of what I'm best at.
And in terms of how you're getting deals in the past and now, what is kind of your bread and butter? What do you do to find your deals?
I mean, really, it's so as a real estate agent, um, when I was selling single family, I remember many times where I'd have like a pretty close friend. Maybe we weren't like close like at the time, but we've been friends for years. And then they would list their house with somebody else, and I would be like, "What in the world? I'm a realtor. Why didn't you list with me?" Well, they didn't know because either they didn't know I was a realtor, period, or they just forgot. And whoever they listed with was in front of them on their mind. And I think that that's true in our world too, being in front of brokers and when they get a deal that is like maybe it's an off market deal or maybe it's a special deal that needs a special buyer, if you're on their mind, then they're going to send it to you. So I think we work hard at continually reaching out to brokers and just having conversations with them, trying to be top of mind so that when they do have those deals, they come to us.
Gotcha. And I'm curious in terms of when you're looking at deals on market, off market, if you're so far off on their asking price, what is your general practice? Do you send them an LOI or do you just email them, say, hey, I'm not going to be close on this, or here's our general number, or do you put it more officially, like I said, in terms of an LOI?
Yeah, it depends. It depends on the deal. It depends on the broker. I mean, most of the time it's a, hey, we're just way too far off on this. And if it's in today's world, the brokers are very used to hearing that. And so in today's world, a lot of times they'll say, just write it up because we need to present offers. And then also a lot of times today it's, this is a seller, because a lot of people that are selling today, it's because they have to. And so, you know, it just depends. But for the most part, it starts with the conversation of, hey, we're way too far. We're not even going to waste your time. And if they say, well, that's okay, please just give us your bet, give us an offer so we can just present it, then we will.
Yeah, I think a lot of times they're also managing their sellers' expectations and to show them, hey, here are the offers that we are getting.
Yes.
And just to kind of get that, because they want to sell the property as well. And sometimes they'll get, let's call it over their heads with a seller to get the listing, and their seller expectations are way too high. They still think it's 2022, 2021 with pricing and interest rates and everything. So I think that's a part of it. And I've bounced back and forth with, I'm going to put an LOI on every deal that I underwrite, no matter what we're at, to I'm just going to send them an email and do what you're talking about. And hey, we're too far off on this one, and kind of see what the feedback is on this. And then, on to the next question. Are there any emerging markets are you looking at any different asset classes? Because we also look at storage, RV parks as well. Or are you just sticking to multifamily? What are you looking towards in emerging trends?
Right now we're sticking with multifamily, except for we do have a office warehouse asset that we own here in Lubbock that it's in an industrial park that we are planning to build a new building for some more tenants on the same lot, and then potentially the next door neighbor lot we may have another tenant, and that just basically is we have some tenants that need a place to go, and it works out. And so outside of that, we're not looking for anything except multifamily. I can't remember what your other part of that question was.
Just any other emerging markets or trends or
markets
that you're looking at?
No, I mean, so basically we're looking at primary markets in Texas, and then Lubbock, Abilene, Amarillo, and pretty much anywhere on I-35.
In terms of your anticipation on exit caps, because you're buying, I'm seeing everything coming out at like a 5.5, 6 cap, sometimes a little bit higher. In terms of your underwriting for the exit and that exit cap, I'm being very conservative, thinking we're going to be either a 0.5 point to a full point decompression. How do you feel about that?
Yeah, traditionally we've underwritten at a 1/10 of a point increase in cap rate per exit cap per year. So if you're in 5 years, you're at a 0.5 point.
And how did you come to that? Sorry.
That I'm pretty sure came from like a mentor, someone else that was ahead of us. That's how they were doing it.
Gotcha. I just haven't heard that.
Really? Yeah. I don't really know if there's like a formula to that, or like what is the?
Yeah, I'm always curious how people take a look at that, because I don't think I've had too many conversations about the exit cap.
I think it has to do with the historical cap rate, movement. Historically, I think that cap rates don't just move super, super quick. And so I think that's where it comes from. But yeah, so for now, I think we're doing at least a point on the exit higher.
Mm-hmm. And that hurts pretty bad on your underwriting. That makes it really, really tough, because even if it just stayed the same, that would make a lot of deals start to pencil, or at least get a lot closer.
For sure. Also, I mean, I would add that if this was the case and lenders were lending 80% LTVs, it may still pencil out. Some deals may still pencil, but now you got to raise, 45% equity, and you got to double that. And it's just like, it just doesn't make sense.
Mm-hmm. And then
Especially when when you got a high exit cap.
yeah, it's tough. It's tough out there for sure. We're almost done. You've been an amazing guest, Tanner. Thank you so
Thanks, man.
much for being on. I got one last question for you, and well, not a question. I really just want you to. What's some advice for the listeners? Because the people who are listening are either just starting out, experienced, but everybody could use some advice to hype them up. Go out there. I know we talk a lot about the market, and it kind of seems doom and gloom right now. But what's something that you can tell everybody to get everybody fired up and go out there, get a deal done?
Yeah, I would say, especially for the new person, I would say, focus on something small. And well, maybe I should rephrase that. Focus on something bigger than what you think you can do, but also relatively small. So, like for us, the 16 unit deal, that was a great size to start with. Don't try to go out and buy a 200 unit deal on your first deal. Like that's just not feasible. But also have if you're thinking you can't do 16 units, if that seems unattainable to you, it's not. Like you can do that. And there are a lot more of those deals than there are 200 unit deals, and they're a lot less competitive, I think. And so I would say, just start. Whenever we did that first deal, we got it under contract with $5,000 of earnest money, and we had no clue what we were doing, but we got it under contract, and we set out to learn how to do it. And just getting that momentum of starting just starts that ball rolling. Or you overcome the static friction of just being sedentary, and then you start moving, and then that ball just starts rolling and rolling and rolling, and you look up, and all of a sudden you own some real estate. And so I would say just start. There's no wrong time to start. There's in real estate, as we discussed before, it's always going to be a great asset to own, and it's always going to be appreciating over the long term. So do your due diligence and make sure that you're, buying at a that your time horizon for owning the asset is adequate, and start today.
Perfect. No, that's great. Start today. Massive action. You can figure it out later. All amazing pieces of advice. Tanner, this was a interview with a ton of gold nuggets in there. Everybody who's listening is going to get a lot out of this. Where can people learn more about you, your company? Where can everybody find you?
Yeah, so our company's website is rebuscap.com, rebuscap.com. And you can follow me. I just started a Twitter back in March. So my Twitter handle is @syndicatorguy.
That's a good one. I'm
Yeah.
surprised that wasn't taken.
Yeah, me too.
That's perfect. Well, Tanner, again, thank you so much. Everybody, this has been the latest episode of the Mastering Commercial Real Estate Podcast. I'm Corey Mortensen, your host, and we'll see you next time.
Thanks for having me.